Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting. We appreciate you taking the time today to spend with us on our what we call Charts of the Week. This is our second installment as we come across information, data, and charts which we find informative and helpful in our daily routine. Some of those we feel would be really good to share with you. And today, I'd like to paint a picture based on some of the COVID-19 data that we see and what are the three perhaps main scenarios that we're looking at from an economic growth standpoint as we look into the latter half of this year and perhaps even into the beginning of next year. So that's where we're going to spend our time today. See our disclaimer for important details. This chart, I want to give credit first of all to RSM, which is an accounting firm, a global accounting firm, and this is produced by their research team, and it's data that most of you have already seen. And so this is essentially a cumulative caseload growth statistic or chart, if you will, dating back to March 1st, which was really we were very early on in COVID-19, and we were just at the cusp of understanding the scope and breadth of the problem that we faced. So you can see that we went from 100 cases at the beginning of March to 1,000 cases, and really almost a logarithmic expansion of cases to where we hit 1 million cases at the end of April. And this graphic indicates that we were approaching about 1.3 million during the first week of May, and we're just slightly above that now. So as this data is accumulated, sometimes it's a few days old, but this graphic is relatively accurate in terms of the cumulative caseload. In this graphic, we depict the newly reported COVID-19 cases, and as you can see, there's that black line is the U.S. Cases. It's a moving average over 7 days, and then the blue bars, the vertical bars, are new reported cases on a daily basis. And this is again something else that we've seen in the news, so it's not terribly incremental, but as we had new daily cases rise exponentially through the end of March. We saw them peak around 32,000 new cases per day at the beginning of April, and that number on a daily basis is tempered somewhat. Now we are testing more, so there's more that we're learning. New reported cases, you can see the trend line there, but clearly there's a bit of tempering going on in new cases that are reported, and on to a rather morbid topic, but one that we necessarily need to touch on because it drives a lot of thought in the collective public conscience on how it translates to consumer activity. The risk of death is obviously out there with regard to COVID-19, and so we look at this data because it's very influential to consumers who represent 70% of the economy on how they conduct their daily routine, what they spend money on. Are they going to participate in the economy as the economy begins to open up? But to start off with, we want to take a look at the mortality rates that are depicted on this chart. So the graphic, as you can see, again, dating back to the beginning of March, when we have very few cumulative deaths, you can see that number rise consistently through April, 50,000 on April 23rd, and this graphic says approaching 75,000 during the first week of May. And we in fact did reach that last week, and we're probably a little closer to 81,000 now, and you can see the projection is going to continue to rise. So we know that that number is continuing to go up, even if the daily deaths are beginning to temper as we're seeing, as we've seen in the previous graphic. What does this really mean for us? And as we look in the investment markets, and this chart, which came from Northern Trust in a presentation they made, I thought was very helpful in terms of understanding kind of these phases, if you will. And it goes from, if you look at the left-hand margin, mitigation to heavy containment, active surveillance, and then to alert. And scrolling across the headers, I mean, you can see the time periods that we know that we're in mitigation right now, and we're transitioning to kind of this heavy containment. Active U.S. cases. We don't have 2 million active cases, but I think we're beginning to see some light at the end of the tunnel, at least on this first go around with COVID-19. You can see kind of the impairments to economic activity in that middle column, the public health measures that are being employed or deployed, if you will, and then activities allowed, and then examples therein. So obviously we're in mitigation. I think it's fair to say that during the latter half of May and into June, we're going to move into that next phase, the heavy containment, and then July and August is we're beginning to see that we're having decrease in active U.S. cases, even though we've got community spread. We'll see more activities, smaller groups, kind of gradually evolving to larger groups, but you're still going to see some mitigation measures, face masks, and those types of things. Obviously, we need more contact tracing, and there's applications on our cell phones that could evolve to help us with that. And then over the latter 3 months of the year, kind of dovetailing a bit when we feel like there's going to be some more perhaps some more meaningful economic growth, then we're on alert. Then we can get back to sports activities and conferences and events and things like that with kind of adequate controls in place. And so, this is a forecast, of course, and we don't know what actually is going to happen, but it's a good template for looking at the next 6 to 9 months, if you will. The 3 particular reboot scenarios that were derived from some work of the conference board, which you can see here in the attributions. It was published in a recent research report by FS Investments, and I've got a lot of respect for Laura Rain, their chief economist there. So with all proper due respect and attribution, we reprint this here. But the work of the conference board centers around 3 particular scenarios on a reboot, basically from that moment in which the governments begin to open and whatnot. And so what you see here are basically a May reboot, which is kind of indicative of more of a opening in May, in which we get a little bit more momentum by the end of this month, and we tend to have a shallower drop in second quarter economic growth as a result of some of the strength that maybe we might build at the latter half of this month and into June. And perhaps with a shallower drop and then maybe a more muted recovery. The next scenario is a summertime V-shape, which is that black line, and it depicts a much stronger decline in the second quarter. Basically, even though we might be opening up here in May, it's going to take a little while longer for us to build ourselves out of the hole that we've dug for ourselves, and we're not going to be able to do that in the second quarter. But then we have the ability to do that in the third, fourth quarter, which kind of leads to a little bit more of a V-shaped recovery. Whereas in the blue line, that's a fall recovery. So we still, in that scenario, it still shows a fairly dramatic, although not quite as draconian drop in second quarter GDP as indicated in the summertime V-shaped scenario. But in that case, the fall recovery actually shows us dropping for a third consecutive quarter. So there's a follow-on decline in the third quarter before a fairly robust increase in economic activity in the fourth quarter. So, and frankly, I think where we are going to wind up is going to be somewhere in between the summertime and the fall recovery scenarios. And in the May reboot, what we see here is that, again, we're not looking for an overly dramatic, although in aggregate terms, a 15 to 17% drop in economic performance is absolutely astounding. But in this case, it's not nearly as much as the other two scenarios. But conversely, as we're opening up the economy and getting our sea legs back, that in the third quarter, we're actually up 10 to 12%, and then fourth quarter, we're up perhaps 3 to 4%. So we're showing the effects in the third quarter of kind of a bounce back, and then a little bit more of a muted kind of growth moving forward throughout the fourth quarter. In the summertime V-shape, this is the kind of rather draconian, as I put it, drop in the third quarter, where the economy in this scenario would drop somewhere around 35% on an annualized basis in the second quarter, which is absolutely dramatic. But it reflects, essentially a large swath of the economy being shut down, and that any recovery or gain that we might have in the latter half of this month or in June would not be nearly enough to offset the preponderance of the data, which tells us that April was an absolutely terrible month. But in the third quarter, with that significant drop, it shows us recovering a little bit more in a much more pronounced way, with the economy being up 20% on an annualized basis in that case, offsetting the 35% decline, and then fourth quarter growth of being somewhere around 15%. So this shows a much stronger, again, to that whole notion of that V-shaped recovery, where you have a dramatic drop and then a fairly strong gain coming out of it. And I'll contrast that with fall recovery, which does not show as strong a drop in the second quarter on an annualized basis as the summertime version did. But still here, we're dropping about 30% on an annualized basis in the third quarter, in the second quarter. And in the third quarter, in this scenario still shows a drop, like there's still after effects, there's still shocks that might be linked to perhaps lingering infection data or some type of negative rhetoric where it shows that the expected unevenness in how we're going to be able to get our economy back and moving, and the fact that it's going to be faster in some areas and slower in others. It's going to be faster in some industries and slower in others. And I think this one kind of lends more weight to some of the risk factors which we know are out there, really, namely the several, the risk of jurisdictions unlocking their economies prematurely, the overly optimistic expectations for prospects for treatments and vaccines for COVID-19, notwithstanding the political uncertainty surrounding the U.S. elections coming up, as well as a potential increase in protectionism as the relationship We hope that you've enjoyed this analysis and this installment of Charts of the Week. As always, we invite you to give us a call, contact us at the information you see on your slide, or send us an email if you have ideas that you think would be neat to be profiled in Charts of the Week. We'd love to hear that as well. And we appreciate your support and your interest, and we hope you have a wonderful week. Thank you.